Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, we've seen now the Reserve Bank and the Finance Minister coming out with a few more actions on the housing market, on lending activity, wanting to focus on a little bit more of that risky lending, feeling like there's still some concerns across the market. What is the latest that the Reserve Bank is consulting on, and why have we got even more action yet again?
Yeah, so they talked about three things in their latest release. One is tightening up the LVR restrictions for owner-occupiers, so reducing the amount of lending that can be done with a deposit of less than 20%. And so that shift there would move the LVR restrictions back to where they were in 2016, which is the toughest they've been. So that's nothing too new there in that space, but a couple of other tools they're looking at implementing. One is setting interest rate floors for the bank, the interest rates rather the banks use when they are assessing whether you're able to continue servicing your mortgage if interest rates go up. Now, we've seen some numbers in the space where the rates the banks are using are sitting around about 6 to 6.3% at the moment. So we're talking about 3.5 or 4 percentage points above where your fixed mortgage rates typically are. So there's my sort of reading of those numbers is that there's probably not going to be a great deal of effect from that coming through from the Reserve Bank, because the banks haven't actually relaxed those lending sort of restrictions or the sort of assessment criteria they put in place a great deal from where they were prior to COVID coming along. The other main tool they're talking about, though, is debt to income ratios and restrictions on those. And that's been talked about before. Under the previous national government, the Reserve Bank asked for permission to add those to its toolkit and wasn't given permission. But there seems to be more positive noises coming out of the Finance Minister's office around those this time around. And so they're going to consult on implementing those later this year. And then the signal probably being that it'll be sometime into 2022 when they start to introduce those.
I mean, we saw coming out from the Finance Minister as well, though, a real focus on not wanting these changes to hit first home buyers. Government quite reluctant to see first home buyers pushed out of the market. But I think we've got to be real that some of the financial risks from these higher levels or these very high levels of risky lending do mean that there are great concerns, I guess, around what could happen if things go bad in the housing market. And just as importantly, I mean, what does this mean for lending activity? Is it going to make a huge impact? And who's going to sort of wear that cost the most?
Yeah, well, what we've already seen over the last few months is that a lot of the indicators of what the Reserve Bank terms risky lending have actually been improving with the reinstatement of the LVR restrictions for investors. And bringing those back in. So we've seen the proportion of lending that's been done to investors has been falling. The proportion of lending that's been done on interest-only loans and revolving credit has been continuing to track downwards as well. So it really is only those debt-to-income ratios which strike me as being the main concern for the bank, and they have continued to push up. And it's not surprising when we look where house prices have gone. If they're rising at 30%, we know incomes aren't keeping pace at that rate, and so people are having to leverage themselves up that much higher and stretch that much further to actually get into the housing market. It's particularly acute, obviously, in Auckland where those house prices are high, but it is spread across the rest of the country as well. And it's not just first home buyers. We are also seeing other buyers. It's not, again, not as critical for them, but there is still a significant proportion of lending going on in that space. So if you were to bring in a debt to income restriction of, say, 6, which is a bit higher than some other countries have implemented previously, you'd still be knocking potentially 25 or 30% of lending out from what we're currently seeing. So those are not insignificant numbers in terms of potentially wiping out a big portion of demand within the housing market. The risk, of course, there for the Reserve Bank is that if they do implement that sort of shift and reduce buyer numbers, the potential for a downturn in the housing market or correction actually becomes that much larger, and you start to get some of those risks around negative equity that the Reserve Bank has talked about almost coming to fruition. So it's a very sort of difficult lever for them to pull. They have to be very careful in terms of how they implement that.
Totally. And I think that's the challenge, right? Going forward, we're going to see more action, not only from government, but from the Reserve Bank with these changes looking to be implemented as we head into the future, trying to balance that risk around the current housing market, but also wider financial settings, and all the while trying to get essentially better housing outcomes, noting that focus and that tension between what the Reserve Bank's trying to target and what the government's also looking at. We'll continue to assess those risks, what the Reserve Bank eventually does, and how the government further responds to housing activity on one of our future editions of Econ Talks.